Okay, perfect. So this is the module that builds on your first module, which was the FIN3601. Okay, 2601 gave you the first 7-8 chapters in the textbook. In this module, you're going to be using the rest of the textbook, and you're going to be covering the other chapters.
Okay.
Right, so you're familiar with the company, so I'm not going to go through this again. That's the mission statement and values. There is more content on the website as well. I've tried to create more content. At the moment, I've started with accounting, so I'm putting out a accounting for non-accountants video series. I've been posting new videos every 1 or 2 days, depending on my time. And I'm also going to be posting more content related to the finance. So I'm going to get to the finance eventually, and I'll then post videos as well. These videos that we have currently, week by week, I'm going to assign your Gmail account access to watch the private videos. So only you will have access to watch the full duration of the actual videos that we have on a week by week basis.
Okay.
Okay. In terms of the package that you've signed up for, we've got the interactive classes. We've got live walkthrough of sample questions and answers, and we will cover a minimum of 2 past papers from start to finish. And if you need any help, I'm available on WhatsApp, Skype, or you can even just send me a question, leave a question via email, and I'll respond to you. Okay.
Okay.
All right. So for FIN3701, you're going to need one of the textbooks in terms of first edition or second edition. You did buy the second edition, so that's perfect. You've got the most recent one that they're still using in 2017 as well. Okay, so the second edition from Gitman, Principles of Managerial Finance, Global and Southern African Perspectives. They've been using that textbook for a few years now, and that's the prescribed textbook for this particular semester. There are 2 assignments that we need to complete, and we'll do those before the due dates. The second assignment is a written assignment. So you do need to submit either, let's say, a written document that you've scanned through or an electronic copy of your actual answers. Okay, so there are 2 assignments. The one is written, the one's obviously multiple choice. Okay, so multiple choice you're very familiar with. For finance, it's probably the first written assignment that you've seen for this type of module. Okay, so let's see how much of the basics you remember from FIN2601. Remember, FIN2601 set the background in terms of the fundamentals, those basic calculations, knowing how to use ratios, knowing how to do some analysis. So for FIN3701, you are still going to use ratios. They do come up from time to time, but we take some of them a bit further in terms of calculations, and others are still as basic as they were in 2601. So I want to ask you what some of these ratios are actually telling me in terms of communicating information. Remember, in accounting, we create the statements, and then financial managers use the statements. So we're looking at the usage. We're looking at how do we take that information and actually make a decision.
Okay.
All right, so the first group of ratios is liquidity. We've got 2 here, current and quick. So can you tell me as much as you can about the current ratio? What does the current ratio tell you? Why is it important? What points can you come up with now based on the current ratio?
Well, it's if you can afford to pay your debts.
Okay, so current is looking at liquidity. So can you afford to pay your debts? Is that short-term or long-term?
I think long-term or no, short-term.
Yeah, it's short-term because liquidity is looking at things that can be converted into cash.
Yes.
So how quickly can we realize cash in order to meet certain obligations? So the focus is always on short-term.
Yes.
Current assets over current liabilities will give you a ratio. Do we want that ratio to be bigger or smaller than 1?
Bigger.
Greater than 1. Greater than 1 would be good. Why? We'll have more assets than liabilities. So if I have 3 assets to 1 liability, what would the answer be? It'll be 3, right? 3 over 1 is 3. Good or bad?
Yes. Good.
Good. So in terms of liquidity, we have liquidity to meet our obligations. All our current assets will sufficiently cover our current liabilities.
Yes.
Great. How is the quick ratio different to the current?
It's less your inventory.
Good. So why do we take out inventory?
I can't remember.
Can we always sell it?
No.
No. Okay, inventory can become obsolete. And because inventory sometimes could be very difficult to sell, we're going to be removing it from the actual ratio, from the current ratio, and that gives us the quick ratio.
Okay.
So current assets comprise of what? Give me some current assets, your accounts. Other current assets.
Well, it's all your machinery.
Okay, machinery is a non-current asset.
Your debtors.
Debtors is a current asset. What else?
Your stock.
Stock is inventory. Good. What else?
The money in your bank.
Good. Bang. Great. Okay, so those are 3 good examples for different current assets. Remember, current assets comprise of resources we control that are used for short-term obligations. So the bank will offer us cash that we can use to pay certain suppliers. Inventory will be sold to generate cash. Okay, that's liquidity. Liquidity is looking at the ability to convert assets into cash in order to run the business.
Okay.
Right, current liability is obviously the denominator again. So if the quick ratio is greater than 1, good or bad?
If it's greater, then it's good.
It's good. So even if I take out all my inventory, so we had an example here of 3 and 1. Let's say our current assets, the total is 3, the inventory is 1, and the current liabilities are 1. 3 minus 1 is 2, 2 over 1 is 2. Quick ratio of 2 is still positive, greater than 1. So that means all our current assets, even if we take out the inventory, can still cover the current liabilities. So is this company going to have problems with liquidity?
No.
No. Will this company have to seek short-term finance?
No.
No. And that is covered in more detail in that 3702. 3702 looks at short-term finance. 3701, which is this module, is looking at long-term finance. So everything that we talk about in this module, we'll be looking at from a long-term perspective, making long-term decision-making.
Okay.
All right, now we've got activity. When you think of the word activity, what are you thinking about?
I don't know. The inflow and outflows.
Of what?
Well, money.
Okay, so sales in terms of customers. So customers buying on credit, customers paying off their debt. That could be activity. What about us as a business wanting to buy goods from a supplier? That's another activity. So activities relate to the operations.
Okay.
Okay, so how active is that particular business in terms of realizing cash by either collecting their outstanding debt from their debtors, or how effective is the business in terms of having good terms with their suppliers? Is it good to have long credit terms with your supplier?
Yes.
Why?
Because then if you have a good relationship with them, it's easier for you to buy more stock without paying straight away.
100%. Okay, so having good credit terms is a way to help finance your business, because your supplier is giving you goods today that you can either use to make products or to sell, and then at a later stage only have to pay them back.
Yes.
Great. All right, so the ratios we've got here: inventory turnover and average collection period. Inventory turnover refers to how quickly you sell stock. So cost of sales over inventory. It depends on what sort of industry you're in. If you're in an industry where you have fast-moving consumer goods, FMCG, those goods are going to be selling quickly compared to other markets where the goods don't sell as quickly. So let's talk about maybe equipment, large items of equipment or cars or vehicles, those industries will have a slightly slightly slower turnover ratio compared to industries like retail, okay, where retail is selling hundreds and thousands of different goods every day.
Yes.
What does the average collection period tell us?
How quick they get their money.
Correct. Good. So here we're looking at the collection. We're looking at receiving cash back from our debtors. Is this long-term or short-term?
I think short-term.
Correct, short-term. Okay, because debtors would be day-to-day running of the business. Right, so the average collection period focuses on your debtors and your sales and looking at how quickly you actually receive the actual payments. Then we've got the creditors here, average payment period. That's focusing on payments to our suppliers, people who we owe money for having bought certain goods from them, where there's a relationship where they're supplying your business with products or services and you're then going to be making payment at a later stage. The average payment period is looking at, on average, how soon, okay, or how late does it take on average to make that payment. Do we want that period to be longer or shorter?
Shorter.
Longer. Okay, you would want to try extend your average payment period as long as possible without incurring additional fees and charges.
But from the business perspective, you want them to pay quicker.
But that's collections, that's debtors. Okay, so debtors, do you want an average collection period that's longer or shorter?
The debtor's shorter and the creditors longer.
Yes, okay, so the average collection period you want as a business to be shorter rather than longer, because that means you're collecting sooner rather than later.
Okay.
We're looking at the payment. You want to pay as late as possible without incurring additional charges.
Okay.
And then you've got total asset turnover. Where have we seen total asset turnover before?
I can't remember that name.
Starts with a D.
Oh, DuPont.
Yes. Okay, so the DuPont model broke up return on equity into three separate components: net profit margin, total asset turnover, and financial leverage multiplier. Okay, we're going to take DuPont further now because we have that basis and we can now expand in terms of more decision making. So we can look at what actually what actually causes the return on equity in terms of the attributes. So is it the sales markup or the margin on our profit? Okay, in terms of the markup that we have on the product that generates a profit, or are we going to be looking at the total asset turnover? So how much sales do I have compared to the assets that I have? Okay, versus the leverage, which is how much debt do I have in the business that helps generate or maximize returns. Okay, so with total asset turnover, do you want the ratio to be higher or lower?
Higher.
Yes, the higher the ratio, the better. So let's say I've got a business A has one sale to one asset. What would their turnover ratio be?
1.
Correct. What happens if I have business B, which has 2 sales to every one asset? What would business B's turnover be?
2.
2. Which is better?
2B.
Correct. Why? Well, if you look at the actual ratio, do you agree both A and B have the same amount of assets? Do you agree?
Yes.
But who's doing more with the assets that they've got?
B.
Correct. B is generating double the amount of sales for every asset they have. So which is going to be a more successful business to run?
B.
Correct. Okay, B would definitely be a better decision in terms of an investment perhaps, or financing future projects in that particular organization, because B shows more promise by being more productive with its assets. Remember, assets generate capacity. Without capacity, businesses can't operate.
Yes.
Now we're changing focus. We're looking at debt. What does debt represent?
Money we still owe.
Correct. Okay, debt is a way of financing projects. So it's a way to get leverage. Okay, one of your last chapters in this module looks at leverage. Okay, leverage is doing more with less. Okay, so you've got a certain amount of assets. If we can really use those assets to our full potential, we're going to generate more and more return. Okay, and it's exactly the same as what we just looked at here in terms of total asset turnover, sales compared to assets. Here we're looking at leverage in terms of liabilities and assets. Okay, so how much of our liabilities are actually financing assets? Are most of our assets financed through debt, or are most of our assets financed through equity? Does that make a difference? Yes. The reason why it makes a difference is because of risk. And risk is a concept you've covered before, yes?
Yes.
Okay, so tell me what the definition of risk is.
Uncertainty.
Good. Okay, risk is uncertainty. No one knows what's going to happen in the future, but we need to plan for the worst and expect the best, because that's the best way of approaching risk. Managing what we can manage and then trying to maximize returns as much as possible. So when looking at the debt ratio is going to give us what information about the business? Well, we've got liabilities over assets. So do I want this ratio to be very high or very low?
Low.
Well, it depends on what type of investor you are or what type of business you're running. If I'm a high risk type of business owner, okay, would I want this ratio to be high or low?
Low.
High. I would want it to be high. So a high debt ratio would represent high risk.
Okay.
A low debt ratio would represent low risk.
Okay.
And the reason for that is this big word over there, leverage.
Okay.
Without leverage, you don't have any risk. Think about it. If you could buy your house cash, would you?
Yes.
Why would you?
Because then you don't have to pay off interest.
Correct. You don't have to pay 20 years of interest. If you can buy a house cash, that's great. But at the same time, buying a house cash may also be a bad scenario depending on your cash flow, because now you're investing all that capital now and it's not generating any return. Okay, if that's the house that you're living in, that's not going to generate any return. But if you're purchasing property to rent out, well, then that's a different story.
Okay.
Okay, so risk is either dependent on the number of debt that you have, okay, or risk can be from external factors. For example, no one knows what's going to happen in the economy, right? Okay, if interest rates continue to rise, if there's more, let's say, unemployment in the market, those are all factors that create political and economic risk that we can't control as a business. Can businesses control their debt?
Yeah, I should be able to.
Yes, they can. Okay, businesses decide how much debt to include in the actual organization or not. Okay, companies decide on their capital structure. Okay, that's an important word that we're going to expand on in a later module. Capital structure. How do we structure our capital? How much debt should a company hold? How much equity should a company hold? Is that right?
Yes.
Great. And then you've got times interest earned. Okay, EBIT is earnings before interest and tax over the interest. The bigger this ratio is, the better, because I'm covering more of my interest payments. Remember, interest is a financing cost for who?
For the person.
Well, the business. Yeah, we're looking at companies. So, yeah, interest would be paid by companies, and that would be seen as an expense. Okay, which is an outflow of cash. Right, a few profitability ratios. You've seen this before in 2601. Gross profit margin, operating profit margin, and net profit margin. All have a different numerator, but they all have a common denominator. Sales, sales, and sales. When looking at net profit, how do we get net profit?
Profit for the year minus preference share dividend.
How do we get the net profit? The net profit is the profit for the year.
I can't remember.
Okay, so we start with EBIT, earnings before interest and tax.
Oh yeah, I was struggling with this last year.
Okay, what do we take off EBIT? Interest first or tax first?
I think
interest or tax?
Interest.
Why?
I don't know, I'm guessing.
Interest is tax deductible. Okay, then I get EBT. Okay, earnings before tax. Now what do I take off?
Tax.
Correct. Then I take off tax, and that gives me the net profit or the profit for the year. Okay, so that's some basic accounting that you need to remember, because yes, this was covered in 2601, but it still comes up again now because you still need to do the calculation to get certain figures to use in the calculation.
Okay.
Then we've got more profitability ratios here, but these are looking more at the actual ratios when we look at the financial statements. So I'm going to be taking out certain figures to calculate EPS. EPS is earnings per share, ROA, return on assets, ROE, return on equity. Okay, here we've got the same numerators but different denominators. We've either got shares, we've got assets, or we've got equity.
Okay.
So market ratios, price to earnings and market book, and book value. All of these represent market ratios, meaning we're taking something external and we're comparing it to something internal. So the market price, is that external or internal?
External.
That's external. That's what companies are going to be sold at in the market in terms of a willing buyer and a willing seller. Willing buyers and sellers will agree on a price for a particular asset. So the market price represents that price. And the market to book, the book value, is that internal or external?
That will be internal.
Correct. Okay, why? Because we look at equity and we look at the number of shares in the business. Okay, so do you agree from a financial management point of view, a company could have a market price that's very different to its book value?
Yes.
Correct. Okay, because perceptions in the market are different to reality. So people might be willing to pay more for a particular company, but the company is not worth the same amount on paper because that's the book value. Book value is looking at internal, market price is looking at external, people's consensus and their sentiment towards a particular organization.
Okay.
Right, then finally, some revision here in terms of DuPont. DuPont represents a system of analysis, and that's looking at ROE in more detail. Okay, we spoke about this a bit earlier when I talked about a total asset turnover ratio. If I take those two ratios, net profit margin and total asset turnover, and I group the two together, I get this, return on total assets. And the reason for that is, if I cancel the sales with the sales, what am I left with? Profit for the year minus pref share div over
total assets.
Total assets. And that's the same as which ratio?
Total asset turnover.
No, return on assets.
Okay.
Okay, have a look. There's profit for the year over preference share dividend over total assets. It's the same as what we've got here. Profit for the year minus preference share div over total assets. Do you agree?
Okay.
Okay. Financial leverage is looking at what? We spoke about the word leverage.
Yeah, that's what was it now?
Tammy?
Yes, I'm thinking of what I'm trying to say now. It's the ability to pay off your debts.
Okay, debt is the key. The ability to pay off your debts, that will be more liquidity, okay, or solvency. Okay, leverage is just focusing on the debt element. how much debt versus equity do you have in the business?
Okay.
So if I have more leverage, is there more risk or less risk?
More risk.
Correct. Okay, so DuPont analyzes ROE in 3 separate components: net profit margin, total asset turnover, and financial leverage. Happy?
Okay.
And that's all the revision that you need from your FIN3601 in terms of the ratios. Okay, there are some other things that we'll revise as we go in terms of certain calculations. So, for example, working out net present value. Do you remember how to work out NPV? Can you still do it on your calculator?
I think so.
Okay, well, we'll revise that when we get to it, but those are all other skills that you've picked up from 2601 that you still need for 3701. Okay, things like calculations. Right, I've tried to show the layout and format of this particular module in terms of 3 categories. So long-term decisions, okay, in terms of investment, long-term financial decisions, and then other considerations. Okay, so all of these bullet points represent different chapters that we'll be looking at over the course. The first chapter, which is today's focus, is capital budgeting and cash flow principles. We're looking at the actual budgeting in terms of how do I allocate funds to certain projects. Okay, what do I need to be mindful of when determining what the cash flows are going to be for that particular project or investment that I'm going to be accepting or rejecting. Then later we'll look at techniques, we'll look at risk and refinements, we'll take the model a bit further, we'll work out cost of capital, we'll do some analysis in terms of WACC, WMCC and IOS. We'll also look at leverage again. We spoke about leverage earlier, it's debt, it's risk. And then capital structure, there's the one that I spoke about in terms of how much debt do I have, how much equity do I have. That's a decision that the company is going to make. Still okay?
Yes.
All right. And then the last few chapters are very short. UNISA has taken 1 or 2 pages from each of the different chapters in the textbook, and they've created some notes, okay, in the study guide, where they cover dividend policy, leasing, and M&As, okay, mergers and acquisitions.
Okay.
All right. So if you can, what I do suggest you do is try pre-read the chapter before attending. That always helps. Or read the chapter after, but you do need to go to the textbook.
Okay.
The textbook is actually very, very good in terms of content. In the past, I've mentioned this before, we have picked up 1 or 2 errors from the actual questions that UNISA has given in terms of assignments as well as the exams, okay, where they've either not given enough information or they've incorrectly asked the question, and that creates a bit of a problem. So we've raised those in the past, and they have improved the module. So from last semester's FIN3701 was very good compared to previous semesters. There weren't as many errors. There were literally 1 or 2 small mistakes, but nothing hectic. In the past, previous past papers were really bad, but the current ones are quite good. Okay, so try, if you can, rather reference material from the textbook rather than the notes, the study guide. Okay. Right. Topic 1, long-term investment decisions. The textbook reference is chapter 8, and the first study unit is looking at capital budgeting and cash flow principles. The learning outcomes here are very specific. We're going to be looking at different motives. What is a motive?
Reason.
Correct. It's why we do what we do. So if I'm looking at a company, what capital will a company have?
Well, it can be financial capital.
Good. Okay, so companies will have different forms of capital. Financial is one example. Can you think of others?
No.
What about human resources? Is that a resource? Is that capital?
Okay.
What about property and plant and equipment?
But what's the difference then? Isn't that just assets?
Those are assets and they're resources. So when looking at capital, we're looking at financing those resources.
Okay.
Okay, so the motive is the why do we finance all of those different assets. So why do we invest in people? Why do we invest in property, plant, and equipment? Why do we need cash on hand? Okay, what is our motive for capital expenditure? Okay, so the motive is the why, and here we're looking at capital in terms of all the resources that we have in the business. Where are we going to be spending that capital? What expenditure are we going to have to incur?
Okay.
Right, we'll look at the budgeting process. We'll define certain terms in terms of the investment appraisal, and we'll look at calculating the initial investment, the operating cash flow, and the terminal cash flow. From an exam point of view, you will always see a question looking at this: initial investment, operating cash flow, and terminal cash flow. There's always a question about that because we're looking at the capital budgeting, and that's the calculation that you're going to have to do before coming to a decision. Do we accept or do we reject a particular project?
Okay.
Alright, so I want to start off with a question, general question. I want you to think about the primary goal of a company, and I want you to write down as many points as you can that actually affect the goal of that company. So if the primary goal of the company is X, okay, what do we need to do to achieve that? Okay, so think about the primary goal first, and then think about an example, okay, that helps us to achieve that goal.
Or profit?
Or profit. Okay, so you mentioned profit. Is profit the primary goal?
Not always.
Okay, profit shouldn't be the primary goal of the company. Okay, you said maximizing the interests of the business. What do you mean by interests of the business?
Well, in general, to obviously make profits and be
Again,
ethical.
you're focusing on profits. What's the primary
No,
goal?
well, I'm saying in general, like the
Okay,
general.
try to be more specific. Primary goal.
I don't know.
What's the primary goal? Value or wealth for who?
For the shareholders.
Correct. Okay, so yes, shareholders are interested in profit, but shareholders want value. They want increased wealth. Okay, so you might have a company that is unprofitable in the short term, okay, but they're still creating value.
Okay.
Okay, so how are we going to achieve that then? Do we accept all projects?
No.
Why not?
Because you first have to analyze if it's going to be, if it's going to bring value and wealth to the shareholders.
Good. Okay, so the word budgeting refers to having a budget. If you have a budget, what does that mean?
Limited resources.
Exactly. Okay, so limited resources are going to have to then provide maximum value in terms of maximizing the owner's wealth. So if we have limited resources as a company, there needs to be a process of evaluating and selecting those long-term investments that are consistent with the firm's goal of maximizing owner wealth. So we need to allocate those resources as appropriately as we can to make sure that we maximize value and wealth over the long term. So short-term pain, but for long-term gain. Do you agree?
Okay.
Okay, think about it. If I go into the gym. Do you go to the gym?
No.
You don't?
No.
Okay, so let's say if you did want to start going to the gym, what would the primary goal be for going to the gym?
To get your body in shape.
Correct. Okay, to get in shape. Okay, to either build muscle or to lose weight, and that would be the primary goal of going to the gym. So if we're going to the gym, do you agree there's going to be a certain amount of time? We can't spend the whole day in the gym, right?
Yes.
So in terms of limited time, that would be the resource. Okay, the only way you lose weight and get fit and get healthy and build muscle mass is by spending time in the gym doing a particular exercise. Okay, that's what we're trying to do here with capital budgeting. We've got limited resources being what? Cash. Do you agree?
Yes.
Okay, rands and cents. Okay, and we need to take that cash and we need to allocate it to areas that will maximize wealth. Okay, so if it's in the gym, if you're looking at losing weight, perhaps you might be focusing your time on doing cardio. Okay, so running on the treadmill, cycling, and so on. Okay, if you're looking at building muscle, then you'd be looking at weights and exercise that'll build that particular area, because that's the goal that you're looking at. Okay, from a financial management point of view, the goal is maximizing wealth, not profit. There are lots of ways to maximize profit that can actually destroy value.
Okay.
Okay, one example that you've seen before in the previous module is giving out loans. Is it good to give out loans, or is it good to give out credit?
Yes.
It's good to increase profit, but it's not good for cash flow. If you give everyone credit, that harms your business, because your cash flow is then going to be affected by granting out credit to your suppliers, not suppliers, to your customers.
Okay.
Okay. What do companies consider when making decisions then? So now we know why they make decisions: to maximize wealth.
Okay.
What must they consider?
Well, what their resources are.
Okay, besides resources, we spoke about that being limited. There's something else to consider as well. That's a bit more important. You can put that here as well in terms of resources. Obviously, we need to know how much resources are available, so that's fine. But what else?
The money available.
Okay, which is still resources.
The employees.
Still resources.
I don't know. The risk.
Yes, there we go. Okay, so that's a consideration when making an investment decision. Remember, risk and reward, right?
Okay.
What's the relationship between risk and reward?
The greater the risk, the greater the reward.
Okay, good. Linear relationship, cap M. Okay, risk and reward should increase. It should be directly proportional.
Yes.
So are all companies the same?
No.
No. Companies have different resources. Companies have different products. They have different services. They're all different. Are they all at the same company life cycle?
No.
No. Some companies are starting out. Some companies are more mature. Some companies are being liquidated. So it all depends. Okay. Not all companies are at the same life cycle. But we know companies all have resources. And all companies will be spending those resources to maximize return over time, to try provide benefits. Okay, increased value. Okay, capital expenditure is the outlay of funds that will be expected to generate future return.
Okay.
Okay, so the motives. There are two main motives that we'll look at in this particular module. The first is expansion and the second is replacement or renewal. Okay, if I'm looking at expansion, why do people expand?
Well, to access more people.
It's to grow, yeah, to try build scale. Okay, so economies of scale, we're looking at growth, we're looking at expansion. Okay, so the motive then would be to purchase assets, non-current assets. Why would I purchase a non-current asset and not pay for expenses? Does paying for expenses maximize wealth?
No, not always.
An expense doesn't maximize wealth. Does a non-current asset maximize wealth?
No. Yes.
Which one? Yes or no?
Yes.
Why?
Because assets generate future income.
Good. Okay, assets can be sold. If you're spending money on expenses, you're getting something immediate. So it's immediate gratification, right? Okay, so if you're spending money as a company on expenditure, okay, expenditure. So if I'm buying stationery for the company, okay, if I'm buying, let's say, paper, okay, if I'm buying paper, does that generate any future economic benefits?
Should.
In what way? Is paper an expense or an asset?
No, it's an expense.
Correct. Okay, paper is paper. Paper gets old, paper gets thrown away, paper gets used. Okay, is there any long-lasting benefit for having paper?
No.
No. But if I invest in a building,
Yes.
why?
Well, that's where you're going to be operating from, and it will generate income for you.
Correct, good. Okay, so that's the motive in terms of expansion. So buying more paper in the business doesn't expand the business. Buying more property in the business expands the business.
Okay.
Okay, so non-current assets are key for expansion.
Okay.
Right, then we've got replacement or renewal. When would we want to replace and renew? Well, the key is efficiency. We're wanting to make processes faster. Okay, we want to optimize the delivery of our products and services. Okay, so replacement or renewal is looking at efficiency. So do we want a new machine? So, for example, you're currently using a tablet, you mentioned, right?
Yes.
How fast is the tablet's processor? Do you know?
No.
Okay, so let's think of, okay, how much space does your tablet have?
You can't ask me anything about technology.
Why?
Because I don't know anything. I just told them, give me the best thing, and this is what I got. So.
Oh, okay. All right, so let me use a different example. So what have you replaced or renewed recently? Let me ask you that question rather than.
Gee, I can't think of anything, to be honest.
So there's nothing that you've replaced or renewed?
No, obviously if you upgrade your cell phone, but...
Here's an example. Perfect. Okay, so replacement or renewal. So you've probably upgraded your cell phone recently, right?
Yes.
Okay, so how is your new cell phone different from your old one?
It takes better pictures.
Good. So is that efficiency?
Yes.
Okay, so it's creating more efficiency because you've got a better quality product in terms of being able to take better photos, being able to maybe use the internet, maybe instead of your previous phone might have been 3G, your current phone might be LTE. So it's faster, it's easier to navigate, it might have a bigger screen compared to your older model. So replacement or renewal is always looking at efficiency. How do we make our lives easier? How do we make those processes more productive?
Okay.
All right, and then the other would be things like advertising, research and development, consulting, etc. Okay, Eunice's going to focus on expansion and replacement. Those are the two that they're going to be focusing on. Okay.
Okay.
All right, so I've got a task for you to consider now. I want you to consider these 5 questions. Have you recently used funds to acquire an expensive asset? Okay. If you haven't, then just think of an example. That's fine. Okay, but think of an expensive asset that you've either purchased or acquired. Okay, and I want you to look at these 5 questions, and I want an answer for each of them. Okay, so take a few minutes to answer those questions. Once you've answered this, so write down your answers. Okay, and then we'll discuss it.
Okay.
Let's start with the asset. Give me the asset that you've used as an example.
This tablet.
Okay. What did you buy? The tablet. Why did you buy it?
For this purpose, let's say studies.
Okay, so why would be the motive. Okay, so you know what the item is. You then need to consider, well, why are you buying it? Okay, that's always key because we don't do things without a motive, right?
Yes.
Okay, how much did it cost?
Well, it's 400 Rand per month.
Okay, so it's a monthly package. Okay, so that's the how much in terms of the budget. All right, so if it cost more than 400, would you have bought it?
Probably.
Didn't you have a budget going into the discussion? So if it was more than if it was double, if it was 800 Rand a month, would you still have bought it?
No.
Okay, why do you say no?
Well, I wouldn't have been able to afford it.
Okay, see, there's the key, limited resources. Okay, companies need to know what is it they want to buy. They need to know the motive behind the purchase, and they need to know what the budget is for that particular product, or in this case, capital budgeting, so capital expenditure. Is that all right so far?
Yes.
Okay, then we need to now know the where and the how. Okay, so where did you buy it?
Vodacom.
Okay, so you bought it at Vodacom. How was it financed? Well, we spoke about that earlier. It's a monthly installment that you need to be making toward that particular product.
Yes.
Okay, so when looking at the capital budgeting process, you'll see that from a planning point of view, okay, all of that gets taken through in a professional context in terms of actually submitting a proposal. So when looking at the budgeting process, companies need to follow a very similar process as the process we've just considered. Okay, the what, the why, the how, the when, the where, all of those W question words in terms of where and why am I doing certain things. Okay, and the way that companies do that is by looking at a proposal. So we need to generate the proposal. Who's going to be helping with that particular process? The finance department. Okay, so people with a background in accounts, people with a background in management and analysis, okay, quantitative analysis or qualitative, either or, they'll be helping with the actual proposal. They'll be generating the proposal. Once the proposal has been generated, you then need to review and analyze the economic viability. What does that mean?
Well, to see if it's worth it.
Exactly. Okay, so is it worth buying? Okay, are we going to go with that particular project? Are we going to go with that product? Why are we going to go with that service provider? Okay, that's the review and analysis. Is it economically viable? Then someone needs to make a decision, and normally decision needs authorization. Okay, so someone more senior is going to either say yes or no after having done all the review and analysis. Okay.
Yes.
If we've got the go-ahead and we start to implement, we still need to check that everything's running correctly. Okay, so there needs to be approval in terms of the implementation. There could be different phases that need to be signed off. Okay, so are we at the right point in that particular contract? Okay, or the contract might be over a specific period. What are the different goals or milestones that need to be met? And the final bit is the follow-up, the monitoring, the evaluation. Was this a good or bad proposal to start with? If this was a good proposal to start with, that helps us to make better decisions going forward because it's based on the history, it's based on the past. Okay, so people with more experience can make better decisions because they have a basis that they can work from. Do you agree?
Yes.
Okay, so what have you recently decided in terms of a proposal? So has there been a proposal that you've presented to someone perhaps? Okay, maybe a client or it could be personal, it could be anything, business or personal, as an example. Has there been a process where you've had to follow to come to a conclusion?
Yes.
Okay, what is it?
Well, I got another job offer. So I obviously had to consider the financial side of it and the long-term benefits from rather rejecting that proposal.
Okay, good. So you've got a new proposal in terms of a job opportunity. Okay, so what was the final decision making? Obviously, there wasn't any authority. You're the decision maker. So what was the decision? Yes or no?
No.
Okay, so the decision was no. So there was no implementation or follow up. Okay, if there was, then you would have the implementation and follow up to evaluate if that decision was correct or not. Okay, good. All right, I'm going to take a quick break there. We've almost had an hour, so I think let's pause. Let's recap and refresh because after the break, okay, the pause, I'm going to take you through a working. Okay, so we're going to cover the theory here. We've got theory that relates to the budgeting process in terms of the cash flow.